everyone, my name is Shiva Kittusamy here with the Nevada or UNR Extension Small Business Education Program. Today's class is going to be on financial ratios, unlocking success for business growth. Before I get started, a little background on myself. I'm one of the many instructors here in Southern Nevada's UNR Extension Small Business Education Program. I've personally owned my own business and startup and had a team of 6, including myself, that market. I was also a finance major, a minor in econ and entrepreneurship. So a lot of the different topics we're going to be discussing today, I have had experience. So I'll kind of sprinkle some of that experience or some of those experiences I've had in the actual business world itself. All right. Also, I might be looking to the left. I got some notes for me, so I can make sure I give the best information to you guys. All right. So let's get started, and let's ask the question: why do financial ratios matter? Probably is the biggest question you might have when clicking on this video. Well, financial literacy is the cornerstone of any successful business. Understanding the language of finance will enable you to make informed decisions, manage risks, and identify opportunities for growth. Whether you're a startup founder or a seasoned entrepreneur, being financially literate means you can confidently navigate your company's financial landscape, ultimately make data-driven decisions, and really ensure the long-term sustainability of your business. I always tell people without financial literacy, even the most innovative ideas can falter, as poor financial management often leads to business failure. This class ultimately will equip you with the right knowledge and tools to decode those financial statements, analyze key ratios, and ultimately drive your business toward success. All right? Let's keep going. So, financial ratios. Lets you make data-driven decisions. All right? Let's start right there. So, what we're going to be learning today in regards to help you make those data-driven decisions is to 1, how to analyze financial statements. 2, key financial ratios. And 3, profitability metrics. So first up, we're going to look at understanding key financial ratios for business growth and success. And a little background on financial ratios. They basically provide essential insights into your company's performance, and they're going to help enable you to make the right decisions for growth and sustainability, all right? And we'll kind of reiterate that over and over again, so it's going to be a very common theme. So we have 4 key financial ratios. So first up is the liquidity ratio, all right? The liquidity ratio provides a key warning system to a company, letting it know if it's running low on available funds. And this ratio measures the amount of liquidity, namely cash and easily converted assets, for covering your debts and provide a broad overview of your financial health. These specific ratios you're going to use when you want to know if you can pay your bills, okay? So, first up on these liquidity ratios is the current ratio. This measures or assesses your company's ability to generate cash to meet short-term financial commitments, all right? Now, there's all these ratios are going to have simple formulas, and I'm going to have pictures in these slides of the formula. So for current ratio, it's super simple. Current assets over current liabilities. That's it. So you're basically dividing those two. with the current ratio, you might have heard it as a different term known as capital ratio. This is, again, one of those liquidity ratios, okay? The next one is a quick ratio, and it measures or evaluates your ability to access cash quickly to meet immediate financial demands, all right? So how we get a quick ratio is we add cash and equivalents and accounts receivable and divide that by current liabilities, all right? Also, as noted in the slide, it's also called the acid test ratio. It is calculated by dividing inventory excluded current assets by current liabilities, okay? So keep that in mind when you are doing this formula. Cool. How to interpret liquidity ratios. For both the quick ratio and current ratio, a ratio of 1.0 or greater is generally acceptable, but this can vary depending on your industry. So I would highly recommend doing some research on your industry and maybe some competitors to you, see what their liquidity ratios are, okay? Also, a comparatively low current or quick ratio can mean that your company might have difficulty meeting its obligations and might not be able to take advantage of opportunities that require quick cash, okay? So these liquidity ratios can also be used for an investor, and they're going to be able to see how your company is basically managing its cash, all right? So again, a ratio of 1.0 is greater usually, but I would highly check your industry. Okay. So some ways to improve liquidity ratio is paying off liabilities, delaying purchases, and collecting receivables more quickly. Ultimately, a higher ratio may mean that your capital is being underused. So we had low. So if you have a lower one, that's really bad. But if you have a high one, this means you're underusing your capital. And this could be a decision, or this could be an idea for you to make a decision and prompt you to invest more of your capital in projects that will drive growth in the business, such as innovation, product or service development, R&D, or international marketing. So Apple, for example, they, I believe, have a somewhat high liquidity ratio. They have so much cash on hand. So what they do is they actually use that money and they do it towards those different categories. So marketing, R&D, et cetera, et cetera. So if you're a startup or you're a business that's holding on to cash, by doing this ratio, you'll be able to determine if your capital is being underused, all right? Because there's a big chance that it's being underused, all right? Okay. So next is profitability ratios. Profitability ratios are used to evaluate how much money your business is making or losing. So these are the ratios to use when you want to know how much profit you're earning, okay? Pretty simple. It's in the name. So the gross profit margin, this specific one, is calculated by subtracting direct expenses or cost of goods sold from net revenue, all right? So net revenue is done by gross revenue minus returns, allowances, and discounts, okay? After you do that, that number is divided by net revenues, then multiplied by 100% to calculate the gross profit margin, okay? This specific one is going to see how much money is left after covering your direct costs of producing or purchasing goods and services, okay? At the end of the day, you want a higher gross profit margin, all right? That's very self-explanatory. It's very much business 101. This ratio or this formula is really going to see what your gross profit margin is in case you have to do a report or something. Next is net profit margin, okay? This shows the amount of profit a company earns relative to its sales. Typically, is after taxes, okay? Hence net. So you're going to do revenue minus cost of goods sold divided by revenue, okay? I believe this is the same formula as gross profit as well. Yeah. Okay. Next is, what is a cross-sectional analysis? So, leverage ratios. Leverage ratios measure the overall debt level of a business, as well as a business's ability to repay new and existing loans. These are ratios to use when you want to know how extensively you're using debt to support your business, okay? And spoiler alert, a lot of companies use debt to fund their businesses, but if you're using more debt than equity, it could be problematic, right? So speaking of debt to equity, this is one of the ratios. This is how much debt is used to finance your business compared to equity. So a high ratio indicates heavy reliance on debt, while a low ratio suggests a more conservative approach, which sometimes limit investment opportunities, okay? So in a banker's perspective, banks use this ratio to evaluate how your assets are financed and typically view a lower ratio as a positive sign of ability to repay existing or new debts, okay? And this is the formula. It's short-term debt plus long-term debt plus other fixed payments over shareholders' equity, okay? Okay. Next is interest coverage ratio. The interest coverage ratio shows how much EBITDA, which is earnings before interest and tax, annually, I believe, a company generates for every dollar of interest and principal paid. Again, higher ratio indicates better ability to service debt, suggesting financial stability and ease in managing debt obligations. From the banker and investor perspective, this ratio is commonly used by bankers and investors to assess a company's level of indebtedness and future financial prospects. Okay. Next up is we have efficiency ratios. So inventory turnover ratio, cost of goods sold over average inventory. This is going to indicate how quickly goods are sold and replaced. Essentially looking at the efficiency of your inventory management, okay? High turnover rates are crucial as longer inventory periods increase costs and affect profitability, emphasizing the need for an efficient inventory management, okay? Oh, also, this can actually help with buying practices and inventory control. So this can actually solve a lot of inventory issues you might have if you do have an inventory. All right, next is accounts receivable turnover ratio. This is an accounting measure used to quantify how efficient a company is in collecting receivables from its clients. The ratio measures the number of times that receivables are converted to cash during a certain time period, and usually a high ratio may indicate that corporate collection practices are efficient with quality customers who pay their debts quickly, okay? A low ratio could be the result of inefficient collection processes, inadequate credit policies, or customers who are not financially viable or creditworthy, all right? So this is also another way that banks are going to see if they want to give a loan to you, all right? And this is also, I forgot to mention, this is also a really good ratio if you are doing a comparative analysis to compare companies within the same industry. But again, there could be some inflated results on this, okay? So the question is, which ratio should you use? Well, every ratio gives you a different insight into your business. How you use them depends on your particular goals. So if you're looking to grow and need to raise capital, for example, your net profit margin will be key. The more profit you can show, the better your chances are of raising the cash you need. On the other hand, if you launch a new product, you'll want to track your inventory turnover to make sure you're aligned with demand. You want to see that the inventory you keep isn't old news, that people want to buy the product, okay? So I would say go back, pause through all these slides. There's a lot of cool formulas in here. I would say most of the ratios have explanations on them, kind of what I was presenting on. These financial ratios are very, very basic in regards to, they're very black and white. So which is usually not the case in the business world. Nothing's usually black or white. Financial ratios are basically black or white, all right? They have one common purpose for one specific aspect of your decision making. I'd say it's a really great tool, and it kind of depends on what you're trying to do. If you're trying to raise money, you should look at some of those ratios like I mentioned, the net profit margin or gross profit margin. If you're trying to get a loan, you might look at some of those other accounts receivable turnover ratio or inventory turnover ratio. So I would say go back through this video, pause, just read the slides, and you'll be good. If you have any questions, guys, feel free to put it in the comments, and I'll make sure that our team is able to answer it. So with that being said, thank you so much for coming to this class. Again, my name is Shiva Kittusamy. If you'd like to connect with me, here is a little QR code that you can scan and get all my information. I'm located here in Las Vegas, Nevada. So if you have any questions whatsoever, but with that being said, thank you guys so much for staying for this video, and I'll catch you guys in the next one. Peace.